All right, this question here is I am still trying to find out the best way to calculate my man-hour rate so that I can compute that number in my production rate formula. All right, so this question is from Jimmy, who's one of our Service Autopilot clients, and so I'm going to try to answer this question. And just to give you a little background, if you're listening in here on the answer, inside Service Autopilot, and I got to tell you about this just real quick so you understand the context of this question because this is a good question. So let me show you something real quick. So this is Service Autopilot you see right here. This is not a promotion of Service Autopilot. I'm just going to point out something, and I'm not going to really do this justice even explaining it. That's not what I'm trying to do here. This is Service Autopilot can do complex estimating. So this is not a complex example here, but let's say you want to bid a residential job. So what Jimmy's trying to figure out is how you arrive at some of these numbers. So if I hit residential here for this client in Service Autopilot, it just figured out, if you look down here, it figured out all the potential services I might want to quote to this residential client. It looked at the square footage of the property and it calculated out the pricing. Okay. Now, these are all completely fictitious numbers, so don't look at any of these numbers and think this is how things should be priced. This is a demo account or just like a account to mess around in. But my point is, here for lawn mowing, if the property was 68,000 square feet, it automatically priced out the service at $103, which that, just again, please don't pay any attention to these numbers. Whereas if it was biweekly, it figured out that it would need to be 167. But you can go down through here, fertilization weed control at 121 an app, 8 apps a year. So anyway, there's these, in this scenario, square footage is tied back to pricing. Whereas maybe if I picked a different scenario here and I was going to do a bush quote, I could go in here and just as a hypothetical, I could say, okay, I've got some hedges and it's a 20-foot hedgerow. I could put in my 20 feet, and then I got 21 large round bushes. I've got 23 medium-sized ones, and I've got 9 small ones. And you can see how it prices it out and comes up with a $297 per trimming price bid. Again, just one real simple example. But so what this question is about is, to set some of these production ratios up and to set up some of this stuff behind the scenes that can do these bids, because this can also do, bids where you put in your square footage for a 21-inch mower versus a 61-inch, and it calculates things out. So where I'm going with that is to figure all that, to really arrive at these numbers, you have to understand what you sell time, what price you sell time at, what price you need to sell time at, and what your pricing needs to be to return to you a certain level of profit margin. And so you can sort of do some of that with Service Autopilot here, where it can build out your costing and you can build out your project manager cost and your equipment rental cost and different things of the sort. But you still, for your basic bids, you still got to understand what you need to sell time at and at what price it has to be sold to bring back to you a certain level of profit margin. And so I'm going to talk here about one way to think about how you figure this out. So I'm just going to shortcut this process here, first of all, and say I wouldn't consider any hourly billing rate under $35 a man hour. I just can't fathom selling time for less than a minimum of 35. And I don't think we don't sell any time for even at $35 a man hour. But just as a jumping off point, as a getting started point, I just can't conceptualize how that would be good to sell time at any price under that. I mean, so there's this rule I've learned in just over time. It's just a rule, and you got to be careful with these kind of things. But you need to mark things up 2 to 3 times. So, like for example, let's just do some costs here. So let's say you've got an employee, and you can go out and hire an employee at $13 a man hour. All right. So then let's say that this guy he costs you. Let's just say he costs you, by the time you match his taxes and take payroll fees and stuff, 8% more than what you pay him. So let me just show you what I mean by that. So in other words, an employee that's 13 an hour, this is actually low, is really costing you at least $14.04 an hour just simply after you match his taxes and pay into Medicare and pay his half of Social Security and such. So, and by matching taxes, I meant Medicare and Social Security. So you've got to first figure out what your real cost of the employee is, and then from there, there's this rule of thumb that 2 to 3 times minimum is what you need to mark that time up for. So if you're marking this time up times just 2. So then you've got to sell this time at least $28. And if you're marking this time up by, say, 3, you got to sell that time at $42 a man hour. This is per man hour. So again, rules are risky to follow rules, but it's just something to consider as you're thinking about this. And I just can't come up with any, just from running the business now for years and thinking about margins and stuff. I mean, this selling time for less than $35 an hour, I don't see how it's profitable. Which is something else you want to think about, which is your non-productive and productive time. So let's again take this guy here that's $14.04 an hour. So when you think about a guy that comes into the office and he has to load the truck, he's got to drive to the first job, he's got to fill out paperwork, he's got to sit through a training meeting, possibly maybe you meet him out in the yard and you go over some training. He's got to meet with you in the morning about the route sheet notes for the jobs he's going to do for the day. There's all these things that are going to happen. He's going to talk to the customer for a few minutes. When they finish the job, they're going to hang some door hangers on the 7 houses around the house they're at. There's these activities that they perform that not a single one of those things I just mentioned are billable time. Those are all non-productive hours. So something to track in the system is your productive time versus your non-productive time. This is actually quite important. And I said to track in the system, I mean to track in your company. And Jimmy, by the way, this is something that Service Autopilot does a lot of time tracking. What I'm talking about now, something Service Autopilot's about to do. I'm recording this video on the 31st of October of 2011. So if you're not watching it now, then the Service Autopilot, if you're watching this after that date, Service Autopilot probably has that functionality. But we've already got it now. We just are about to start reporting it back. So you want to kind of figure out what are your productive versus non-productive times. So let's say you are running 30% non-productive and 70% productive. All right. So if you were going to, just some math here, let's say you're going to bill this guy out just 40 hours a week. We're just keeping this simple. So he's going to do 40 hours a week, and at his $14.04 an hour, which is your cost. So he's costing you $561. I'm sorry, that's what you're paying the guy. Okay, that's not what you're billing him out at. So if he's going to work 40 hours a week, so let's just run that math. So 40 hours times 30%. So you've got 12 hours of the week that you're not going to generate any money for. So that's going to leave you with 28 hours that is billable. Okay. Now if you use a billing rate of, let's just say, we'll just keep it simple, 30 a man hour. So you're looking at what did I do that for? All right, let me redo this. So if you're going to bill it out at 30 a man hour, and you're going to get 28 hours a week, you're going to generate $840 off of this guy. Okay? Hopefully you're following me so far. It's because you only bill out 70% of the time as productive hours. So here's my hope in this. As I work through this, you see kind of how I'm thinking about this. And because I'm just talking about one scenario, one way to think about this, and I'm trying to keep it simple. And so as you see how I'm thinking through this, hopefully it'll give you some ideas of how to think about this. All right, so here we have it. We've got 70% of his time's productive. So that means at best case, he can only bill out $840 per week. All right. Now, we know that he's costing us this $561. All right. So that means right here, this is our gross profit margin, essentially. If we're just keeping this simple, we're just selling labor. Our gross profit margin here is $278. So what is that margin? Let's just calculate that out real quick. Equals. So 33%, which would be a wonderful profit margin if that was your net profit margin. But this is gross profit margin. So I calculated that by, I took my my gross profits left over after I took his labor expense out of his revenue that he's producing for the company. I then divided that number, the gross profits, by his total production for the week, his gross revenue, and it came out with a 33% gross profit margin. Okay? So the problem here is that this sounds really exciting if this were net profit margin. I mean, that's really, really good. Now, the problem is that from here, we've got to think about the other expenses that come out of here. So, for example, what equipment does he have that he's using? Has he got, we'll just make a little list over here. Does he have hedge trimmers? Does he have a mower? What is the equipment he's got? Has he got a rider that you're throwing in there at $30 an hour? Then we've got other expenses that you may not be thinking about. If you give him any level of benefits, gas, truck, if I could type, supplies, your materials, whatever, the same as supplies. You see a few of your expenses here. So these are just some of your, I would call these things direct costs. All right, so let's talk about what that means. All right, so direct costs are your things that are tied directly to the job. So for example, if we went out and we sold $840 worth of labor this week, let's just keep it simple. It was one job. He was at the job for 40 hours. We billed it out $30 an hour, a man hour. So we were only able to bill out 28 of his hours. So we made $840. Now, these costs right here are all, in a sense, actually I should not be lumping in some of this equipment cost, but let me just kind of give you, some examples here. This gas, the supplies, these are direct costs tied directly back to this job. All right. So, for example, you would not have used up gas, you would not have used up supplies had you not performed this job. They're directly tied back to it. So those expenses would have never been incurred. Another definition that's worth knowing is unless he's on salary, if he's hourly, he's in a sense of variable cost, meaning that his cost goes up and down depending on how many hours you work him, which is probably dependent on how many hours you bill him out at. So that's something, as you're just thinking about this, that's another definition worth knowing. Now, in all reality, some people might call hedge trimmers and mowers and riders and the truck fixed costs. And they are, meaning that if you went out and you bought, maybe you financed this stuff, so you've got we're just going to make something up, but let's say for all your equipment, you have a $700 a month payment on the equipment, the truck, and the trailer and everything that went into doing, $700 a month. All right, so if your employee that made $840 didn't do any work this week, he did nothing, then this $700, you still got to write that check at the end of the month. It didn't go away. It's a fixed cost. You incur it regardless. All right, so it's got to be paid whether or not you bill another hour out this month. So they call that a fixed cost. All right, now you could argue, to get a little more complex, that hedge trimmers and mowers and rider and things like that are a direct expense tied back to the job, because as you use your hedge trimmers, mowers, rider, they lose a little more value because of wear and tear and such, and all of this loses value just simply because of time. But it especially escalates as you put more hours on a piece of equipment or more miles on a truck. So there is some level of direct cost tied back to earning this $840, even through the equipment and through the trucks and such, because you're using up the useful life of those trucks and that equipment. All right. So the point is that the reason I'm talking about all that stuff is, let's just keep this simple, and let's just use what we would call our direct costs. You could maybe call them variable costs. I'm not sure if those are the same, but direct costs would be one way to call this. So variable cost is actually a good way to describe these as well. So these are, again, your gas, your trash bags, your weed eater line, your different expenses that are incurred to go out and perform this $840 worth of work. So let's just say to do this work, you had, hypothetically, with gas, $100 in direct costs. All right? All right. So now, if we subtract this out, let's just look at how this affects it. All right, so now we're down to $178. So let's calculate out the profit margin. You know what? That's wrong. So let me do this here. So it's going to be that divided by that. And now we're down to a 21% profit margin. I actually still like that profit margin. That's good. This is a gross margin. All right, so now from here, and again, you can't get caught up on any of these numbers. They're just examples of how you calculate this out. So now from here, we've got to still allocate our overhead. All right, so our overhead, there's some number for every hour we sell. There's some amount of overhead included. So one way to, gosh, this is just so hard to explain simply because, well, let's look at it this way. Let's say that you did $100,000 in your business this year. All right, so your business did $100,000, and if you look at all the expenses in your businesses, don't go away next year. So they would be like your office assistant. You could potentially throw your salary in here if you're not out producing work. Your office help, these people that are in the office that essentially are in a sense fixed costs, their overhead, their your trucks, your equipment. There's some percentage of this $100,000 that you did last year. If you add all those expenses up, maybe they come out to $20,000. So that would mean that you have that 20% of your profits are, or I'm sorry, 20% of your gross profit is the expense of is 20. I'm saying this completely wrong. Sorry, of the 100,000 in gross revenue, if you spent 20,000 in overhead expenses, then 20% of your costs, 20% of your revenue is consumed by overhead costs. So remember, you billed out 100,000 last year, so that was at your billing rate. So if all that $100,000 was sold at $30 per man hour, then you can take 20% of that $30 a man hour as just a guesstimate or an estimate of your overhead cost. So let's just do that for example. So let's say that at your $30 per man hour that you're selling time, 20% of each hour you sell is overhead cost. So let's look at what that might look like. So we 30% is $6. 20% is $6. So we can just take or we could take 20% of the $840 that we sold. So let's just do that. So equals $840 times 20%. Oops, I screwed that all up. Let's fix this. All right, so we got $168 in overhead costs now. All right, so now let's calculate out our margin. Now we're down to a whopping $10, and this is probably going to be pretty close to net profit. Probably. I mean, this is a simple example. So if you can absolutely find fault with my example here. The point is to just kind of explain the concept. I may have misstated a few things. I've used some fake numbers. That's not the point. The point is to explain the concept. Now we're down to 1% profit margin. So in this case, because we've taken out our direct costs, our labor, our overhead costs, our fixed costs, we've taken all those things out of the numbers. Now we're probably down to our net profit. So we, on a week's worth of work, sold at $840 in this example. We're now down to $10 of profit for the week. And that's 1%. That's terrible. There's no point even being in business. So you can kind of see how this works out. So, if I don't, let's see here if I could do this. I don't think I set my formulas up. Yeah, I did. Okay, so look at what happens here if I just go to $5 additional per man hour. With my example, I immediately jumped my profits to $150 for the week and my profit margin to 15%. I mean, that's a big change. Just going up to the basis that I said, which was $35 a man hour. If I go to 40, here we go to, now we're taking $290 off the table as profit, jump it to a 25% profit margin. When I go from $30 to $40 a man hour, nothing changed. My overhead didn't go up. I didn't spend more gas to get to the job. I didn't spend more on supplies that week. Nothing changed. So it's all pure profit. And so this is why pricing is so important, and figuring out your correct billing rate is correct. Now, obviously, the problem with this is there's market limitations. So, I mean, I'm not telling you anything you don't know here. If I $50, I may not be able to sell work at $50 per man hour. Sure would make me a nice amount of profit. It would make me a great profit margin, net profit margin. That's incredible, 40%. However, I mean, what's the reality of selling work at $50 per man hour in your market? I don't know. I mean, again, this is just an example, but you can see what $35 means versus 30. So this is one way to think about it. The problem with this example is that it's challenging to figure all of this out. It's challenging to figure out what is your overhead cost. And I kind of gave an example of looking back at last year and taking your gross revenue. So let's go back over there of 100,000, and then figuring out what all your fixed costs are, the things that don't go away that you've got to have just to operate the business. And coming up with what that number is. And you can search Google, look at what are fixed costs, and look at some of these calculations. Search on how do you calculate overhead. Just read about it. The dilemma is, and it's the challenge I've always had, I find it challenging to calculate overhead because nothing is textbook. You didn't make a clean $100,000 a year and have a certain number of overhead expenses that are going to play true this next year. Everything's constantly moving and changing. Your business is nothing's that simple. So you can get some ballparks, you can make some guesses, but like for example, overhead could have been low last year. Now you're really reinvesting in the company. I mean, like I'll give you a great example. Like right here, if I only made 100,000 next year, and I'm going to go hire a sales guy for 30,000 bucks and just pay him, he's got a salary of 30,000 bucks. And if I add that to my overhead from last year that I'm keeping now, it looks like I'm running a 50% overhead. Well, that's silly. If you're running that, you're not going to be in business for long. So obviously, because you're going to add the $30,000 sales guy next year, maybe you'll have $200,000 in revenue, and now you'll have 50,000 in overhead. So now, actually, I did that wrong. So I did this one wrong. So it's not 50%. It's more like 25% overhead now. It's up from last year. Again, probably poor examples, but hopefully it communicates the idea. So one way to figure out overhead is to look at how you did in the last year, look at your gross revenue, and then figure out your overhead and figure out that percentage, and then take that percentage against every job you do. So I've got to say something about that here. The problem is this is where it gets even more complex. There's something called overhead recovery. And again, you can Google some of this stuff and learn about it. But overhead recovery is a concept that I'm probably going to misstate a bit, but like there's a point where as you sell time, you've essentially recovered all your overhead. So for example, so let's go back to this example. Let me delete some numbers here. All right. So we said that our overhead was 20%. Okay? And then right up here, I went and I took my numbers, my $35, and let's go back to 30. Okay? And so I figured out that if I sold 840 hours, or $840 worth of labor at my $30 an hour billing rate, 20% of that would give me an overhead allocation of $168. So I would allocate $168 to that. Now, once I've recovered my overhead, so if that overhead calculation is based on selling 40 hours a week of labor, or whatever the case may be, when I'm into 45 hours worth of billable work for the week, or 50 hours worth of billable work, I don't have to continue to allocate overhead. My formula was based on recovering overhead at basically at 40 hours per week of billable time, or 40 hours per week of time sold. When I'm selling more time, I no longer have to factor in overhead. So for example, taking all these numbers, like let's say that I went and sold another hour of time right here for $30. I would have some direct cost on that. Okay? So let's say my direct costs on it were $5. Okay, so now I've got a gross profit margin of $25. But now I don't have any overhead. It's zero. I already fully recovered it in the prior 40 hours I sold. So now I've got a profit of 25 bucks. Now, I didn't use my numbers quite right, but you can see the difference here when I was recovering overhead, again, these numbers are not quite accurate, but when I was recovering overhead, I was making a $10 an hour profit margin. Once I've recovered overhead, then all additional time I sell over and above, I'm making a profit of $25. That's a huge difference, just huge. So you've got to be careful with your overhead calculations as well, because you can over allocate your overhead and be unrealistic about what your margins are going to be. So these are really good topics to read about. That's one of the reasons I've went into some depth here on this topic. So I think where you want to start here is you want to figure out how much you need to sell time at. And you actually sell time at different prices for different types of people. So like for example, just continuing to use this as a worksheet. Let's say I have a bush trimming guy and I pay him $14 an hour. Okay, so you got to factor in your time, your cost. Now let's say I have a spray tech, and so maybe I pay him $16 an hour. Maybe I've got an irrigation guy that's getting the equivalent of $20 a man hour. Well, I'm going to sell all of these services at different billing rates. All right. Maybe I've got a laborer on a mowing crew that makes $9 an hour. Okay. All right. Now you're going to sell all their time at different rates because they cost you different amounts. Now you might be able to find averages within that. So for example, if I got a mowing crew, so let's just call this a mowing crew. And within the mowing crew, I have a foreman that makes $14 an hour. I've got a guy that makes 10, and I got a guy that makes $9.50 an hour. All right. So I've got an average here of, I've got an average here of, let's just figure this out, $11 an hour. So you might take the average of the crew to figure out what you need to bill these guys out at. I would keep it simple. I'd use my $35 if that was the example you're using to bill these guys out at per hour. It's simpler to come up with your crew rate from a calculation standpoint. So you need to arrive at that number, and then from there you can figure out how to price work. But my point is, this number is going to change. So for an irrigation guy, maybe you bill these guys out. You're going to bill them out at a totally different hourly rate than you're going to bill out a guy that's mowing. And obviously part of that is because you're paying the guy more. And maybe the market will also bear more because of the expectation of the buyer, the homeowner or the commercial property, in terms of just how the market works. They are willing to pay more on a per hourly basis for a irrigation guy, meaning that maybe you're, like for example here, if if your average cost on a mowing crew is $11 an hour, you're selling time at $35 an hour. That's over 3 times. However, maybe your irrigation guy you're billing him out at $80 an hour, but you're paying him 20. That's 4 times. So you'll notice that there's a variance from service to service in terms of how much you can mark that service up and sell the time. And some of that has to do with what is accepted in the industry. That's why you'll see that some services in your business are going to have higher margins than other businesses. You may have never thought about the math behind the scenes on how that happens, but the way it happens is obviously a lot of times you're bidding work and you're losing it, so you're adjusting your how you're pricing the work, which really all you're doing is adjusting down what you're selling your time for. And you've accidentally arrived at a point where you sell mowing time less than you sell irrigation time just because you didn't realize what was happening, but just as you were selling it and losing things, you kept adjusting it down to a point where you found you could win work and you start to quote work at about that rate. And that was all just based out on what the market would bear. And that's how you ended up at those billing rates. Now, I'd argue that that's still not the right way to do it. You have to be, you can have the greatest, you can say all day long that I'm going to sell work at $80 a man hour, but if you can't sell it, you can't sell it. You're going to have to figure out how to be more cost competitive. You're going to have to get your costs down. You're going to have to do something. But where I'm going with this point is that you will find in your business that you can sell different types of time at different levels of profit margin, at different basically for more profit than other services. And it's the average of the whole that creates your total profit margin in your business. So I would not try to come up with one number that you sell all time for. You want to come up with a number that you sell mowing services for versus irrigation services versus fertilization and weed control services for. Also, for each of those services that you're selling time, like mowing, figure out figure out what you're selling that time for net of equipment utilization. All right. So one of the reasons I hesitated earlier when I was talking about fixed costs, and I tried to throw your mower and your rider and your truck in there, the reason I don't like doing that is because, as I mentioned, things I think of that are better examples of fixed costs are going to be your office, your rental, like your office rental, your office secretary, your software to run your business, things of that sort that don't go away as, or they don't necessarily diminish or increase exactly as your revenue diminishes, your gross revenue diminishes or increases in your business. They don't fluctuate and keep up exactly with how your revenue moves. All right. Now, and that's why I think you can't really throw trucks and riders and mowers in there. And you want to do a little research on this and double check me on this. But the way I think about mowers and riders and trucks is they deplete the more you use them. And so as you're figuring out your numbers, you're maybe arriving at the fact that you need to charge out your mowing guys at least $35 per man hour. Okay? That's what you're selling the labor for. Now, you don't put your mower and your rider and your truck into your overhead cost, into this number right here, that in our example gave you a 20% overhead cost. You don't put those numbers in there. Rather, what you do is you figure out what it costs per hour to sell the usage of the equipment. So think about it as an example. If you were to go rent a Bobcat, they in their business have figured out what it costs, how much the life expectancy of that piece of equipment. So they know that a Bobcat it has a reasonable life of hypothetically 5,000 hours. Now clearly the maintenance cost increases as it gets older and it's less as it's younger. They figured that out. And they figured out all the parts and all these different factors, what it costs to, what the overhead at their operation is for employees to, stand behind the desk and rent this out, and all kinds of things. And so they've come up with these numbers. They have then figured out what they want their profit margin to be, and they rent that piece of equipment out. Very much like you do with people. Your people are kind of like your equipment. You figured out what they cost you, you figured out what your profit margin is going to be, and you rent them out to the client. Well, you kind of want to think about your equipment that very same way. You want to figure out what it costs per hour to run a lawnmower. So I'm getting way more sophisticated here than 95% of the market's going to think about lawn care and how to price it. All right. So you can keep your life a little bit simpler and just, kind of guess at this stuff and work at it, which I don't necessarily recommend. My business has been a balance of thinking about it this way and actually, looking at what some of my competitors are pricing work at and starting there and then watching the numbers. I mean, I'm not textbook in theory here. I mean, I'm realistic about this. The reality of this is you are not going to sit down, calculate all this out, and come up with this magical price to charge. Very few people really do that. A lot of people talk about it. Very few people really do it. Some guys do. The guys that are running big companies at thin margins, they have to know all these numbers. They have to, or they'd be out of business. And my point is that the reality of how you're going to approach this is you're going to look at what your competition is selling their work at, and I would most focus on the guys towards the top of the market that are selling work. You're going to start your pricing around what they're doing, and you're going to just start tracking square footage and time against what you're charging, and get a feel for how you're doing. And then you're going to go back and run numbers like this, and you're going to kind of compare it. You're going to figure out how to tweak it. You want to get to this point in your business, especially if you're going to be a bigger company. But the reality of it is, it's not all about this. The reality is you really are going to look at what other people are doing and kind of start there and then measure from there. So something else to think about here is that if you figured out that you sell labor at $35 a man hour, now you need to figure out what you sell your 21-inch mower at. All right, so in my business, for example, if I can buy a 21-inch Toro mower, and we have fleet pricing, so at $850, if I can buy this thing at $850, and then I can sell this thing for $550 used at the end of the year. And along the way, I'm going to drop $200 into it. All right, so let me do some math here. So let me use a more realistic number. Let me do this a little better. 1,100. All right. So this mower is going to cost me $550 to run it for the year. If you do what we do, we buy our equipment, sell it at the end of the year. You don't necessarily need to do that. That's how we do it. All right, so it's going to cost me $550 just in the cost of the equipment. Now let's say I'm going to have $200 that year in maintenance in it. So now I'm at $750. Okay. All right. So now let's say that I run this piece of equipment for let's just say 34 weeks of the year, and this equipment runs for an average of 40 hours a week. Okay. So let's say we're gonna use it for 34 weeks at 40 hours a week. So we're going to use it for 1,360 hours. I'm going to divide my $750 in equipment cost by my 1,360 hours, and I'm going to come up with a 55-cent per hour cost. Now, if you want to get a little more sophisticated, if you finance that equipment, build in the financing cost. There's all these other formulas you can use. I actually don't get that complicated with them, because there's a cost of money, because you paid for this thing. But anyway, I'm not going there. Keeping it simple. 55 cents. All right. So that would mean then over here, I've got my $35 an hour right here that I'm selling my work at. For every hour I sell, and I've got a mower, so this is my labor. I sell it for $35 an hour. I sell my equipment at my mowers at 55 cents an hour. And then maybe I sell my weed eater or line trimmer at I don't know what that would be actually. 30 cents an hour. In my stick edger, let's just say, don't get caught up in my numbers. And I got a blower on the site. Blowers tend to. Okay, so you got some costs on here, all right? So when I add all this up, now I might arrive at a number that I want to sell work at on a mowing crew. $36.40 an hour, hypothetically. That is not what I sell work for, so don't copy that. But you can kind of get the gist of how you might think about that. Now, you take this same scenario here. Okay. Let's take this same scenario. Now let's say that we're selling a different kind of mower here. And I only gave and this was for one man. Now let's say that we're also same property. We've got all the same expenses, except now I'm selling the usage of a Skag or a Toro or something. Maybe I buy that thing at $8,000. I don't sell these every year, so what's the useful life on it? Maybe it's after 3 years you can sell it for $3,800 hypothetically. So you go through the same calculation and you figure out your maintenance cost. I didn't build fuel into here. I don't necessarily think you need to. That may be covered over here under your direct costs. So I was just selling the cost of the equipment. So you get the idea. It's not a perfect example, but you get the idea. But you then start to arrive at, so maybe you sell this mower at $1.02 or $1.03 an hour, and you can see how that has an effect on the billing rate. So if you're selling 3 man hours at a commercial property, if you want to get really sophisticated, maybe 2 of those hours are sold out at $36 an hour because of the equipment that's being utilized on the job site, and 1 of those hours is being sold at a higher rate because you've got a different piece of equipment on the job site. So this is a way to think about this. All right, so enough of that. Let me just take one more stab at this question from a different direction. Your question: I am still trying to find out the best way to calculate man-hour rate so I can compute that number in my production rate formula. So here's a different way to look at this problem. Let's just say you look around the marketplace and you theorize their selling time at $35 a man hour, okay, for mowing a yard. And let's just use one guy. One guy goes out to the property at $35 an hour. So now let's say you have a property and you've measured it, and we'll just use gross square footage for example. So it's 10,000 gross square feet. So you log that, you track it. I'd recommend that you also track the turf. Maybe that's 5,500 square feet. I'd keep track of that. I'd also recommend that you track the lot type. So maybe it's an interior lot versus a cul-de-sac. Okay, corner lot, whatever the case may be. I'd track a few things about it. Swimming pool, you might consider that if you've got swimming pools in your area. All right, now, so you've got, and so this 1 yard here. You think that you should charge $35 for it. One guy's going to go out and do it, right? And you sell time, or better, let me say it another way. You think it's going to take 1 hour to do it because you sell time at $35 an hour because you look down the marketplace and you theorize that's what other people are doing. You priced it at $35. All right, so you didn't do any of this other stuff we just got done talking about. You just started here. So now, here's how you check yourself. Week 1, all right, so we got these base numbers. We've got them in our system. Now, week 1, we go out to the job. I got a lot of stuff going on in this spreadsheet. Start, end, budget. All right, it's better said. We also need to go up here and we need to put in our target. 1 man hour, all right? Okay, so this is budget. Let me show you this. 1 man hour. We do all this stuff in Service Autopilot. So when you get to the job site, you clock in. You clock in at 8 a.m. When you get done, you clock out of the job at 9:05. That was week 1, okay? Week 1. Week 2, you got there at, we'll just keep it simple, 8 a.m., clocked out at 9:10. Week 3, 8 a.m., clocked out at 8:55. All right? Your budgeted time each time was this. So now, let's do a couple things here. We are over budget by 0.05, 10, and we're under budget here by negative 0.05. Yeah, I knew I was going to get an error there. Anyway, you get the idea, all right? So first thing we're starting to find out is, are we even hitting our target? We bid this job at 1 man hour. Are we even hitting it? So on average, for across these 3 weeks, we are over budget by 10 minutes. So we're immediately losing money based on what we bid. This is the most basic thing you watch. Do we even hit what I bid this math at? So, for example, you sold this at $35. Well, based on this math, based on your never actually achieving $35 a man hour because you're always out there longer, you probably really ended up selling this time at $33 a man hour. You sold it at 35, but you're really only making 33 because you're, first of all, underperforming. That's the first thing to check. All right, so then once you figure that out, the next thing is, because you're watching your start and end time here, let me get rid of this budgeted time. All right, so now we've got our price, 35 bucks, okay? So if we look at this, so from 8 to 9:05 we were there for 65 minutes, okay? So if I divide, so let's do equals, I'm going to divide $35 divided by 65 minutes. It means I'm making 53 cents per man minute. I like to look at this man minute number, silly as that might sound, because what happens is I can come up with a number in my business, and I can scan all of my reports, like the job costing report. I could scan all my numbers, and I could scan all my work for the day per man minute and see if it calculates out man minute and tell me how I'm doing. So with this one number, I could scan 300 jobs for the day, and if the average man minute that I see week after week is, let's just say, 53 cents a man minute, and now I'm seeing one at 40 cents, and I'm seeing another at 30, seeing one at 65, I immediately know everything under 53, this is not right. I'm not hitting my averages. So this is another number to watch. And then what you do is you go into those clients. All right. So then once you find the clients that are underperforming, you go in and you look at what I was talking about here. You look at when you bid the job for $35 an hour, you thought it was only going to take 1 hour. But you're really going over budget. It's taking 5 minutes over this week, 10 minutes over this week. And then you start to see all the places in your business where you're not performing because you're not actually even achieving getting the work done in the time you bid it at. And you fix that stuff first. You start adjusting that. You start watching your man minutes. So that'll bring up your average your earnings per man minute. And so you kind of start at this level. And that's usually the first place to start. Then you start getting into some of these calculations and checking these numbers. By going through the exercise I went through, it'll make you start thinking about your costs and your numbers. So if you use QuickBooks, you got to look at your profit and loss statement. If you use Service Autopilot, you got to look at the profit and loss statement. You got to get into your expenses. You got to drill down into some of this stuff, and it takes some time to figure this out. But the more you look at your numbers, the more often you watch them, the more often you actually sit down and calculate them out. Like you take a crew and you literally chart out, this is how much money the crew made, these are the expenses we had for the week, and then you start thinking about all those things, those expenses on the crew, like the truck and the equipment that didn't really show up in that week's expenses, but you were using up the life of that truck and the equipment. You start to note that stuff and you start thinking about this. And also in the crew expenses, you didn't account for the office, and you didn't account for somebody back at the office and all those expenses. You start thinking about that, you'll really start to learn the numbers. So you usually start pretty basic. You usually start out with your pricing modeled after the industry. Then you start watching how that pricing is working inside your business. Are you even hitting your bids? And then you start coming up with some basic metrics that you watch. And then you get a little more sophisticated and you start breaking them down. And then once you start feeling these numbers and playing with them a bit, then you start to learn where you've got issues, and then you start tweaking them. That's when you get to have the confidence to come back around and say, you know what? By playing with these numbers, this 35 seems a little low. I need to be at least 39.75 an hour. Or when I'm doing this commercial work because I've got a Skag or a Turf Tiger involved or whatever, or a Toro or Exmark, I really need to be at 45 a man hour. Anyway, this is the beginning of starting to learn the numbers in the business. And so this is one way to approach it. I hope that helps. Thanks.